Hello, my name is Matt Russell. I'm an FX Power Course instructor here at FXCM. I want to welcome everybody to the Daily FX Walkthrough. Going to get started in just a moment. What I'm going to do tonight, as always, is walk through the latest technical report by Jamie Setley at DailyFX.com. So let's go ahead and pull up that report. And this is the same report that I've been using for my past several Daily FX walkthroughs. What I want to focus on again is the Kiwi dollar, and just read the synopsis. The implications from a short-term head and shoulder pattern are bearish as long as price is below 59, 0.59 that is, but there remains the possibility of a larger recovery in a C wave to above 61.37. So let's go ahead and pull up the charts, and the first chart that I want to speak about is the euro dollar. And if you recall in yesterday's report, I was mentioning how I was leaning towards the possibility for an upside breakout in the pair. That's exactly what we got, but however, as soon as that happened, there was a massive reversal to the downside. Sometimes the currency world is a cruel and dark place, and this was one of those times. We can see, let me change the style of the candlestick so you can see this a little more clearly, the breakout. And I want to show you exactly how I traded this breakout in the pair, the mistakes I made. We never learn personally, I never learn anything from my winning trades. It's always my losing trades, and this is a losing trade that I want to speak about. We had the breakout above the area. I actually missed the moment that the pair broke out, and I was waiting for a retest of the resistance line from the opposite side. I was expecting it to act as support. I jumped the gun a little bit. I just got in just below that 127 figure, expecting the pair to bounce. It did not. The pair did close. The pair did close back beneath the former resistance line, what I was expecting to be support, and then I exited the trade on the close of that candle. I lost about a little over 50 pips. I think it was about 53 pips on the trade. The mistake in the trade was that I didn't wait for that candle to close, but moving forward with any other trade, this is a trade situation. Even though I did lose in this particular trade, I would have made the same move just from experience, and what are you going to do? You know, you can't win them all, and this is what I did. The good thing that I did, and the most important thing that I did, is that I exited the trade as soon as there was a close back beneath that previous resistance level, which I was expecting to act as support, which it clearly did not once we had a close beneath it. So, you know, as I'm saying, it's a learning experience, and we can learn from it and move forward. Right now, with the pair, that was a nasty reversal. This could still be the triangle count. This could be a spillover, and you know what happened today was a very bearish thing. So again, as I was mentioning yesterday, I would just ignore that upside breakout and still have that slight bearish bias against this resistance line. Moving forward, the next chart is the dollar yen, and nothing much has changed in this pair, as I was mentioning, to maintain that slight bearish bias against the resistance line. We can see prices are still contained beneath the resistance line. We didn't have an upside breakout as we did in the euro dollar. These are inverse currency pairs, so it would be unlikely for that to happen. However, again, moving forward, maintain that slight bearish bias against the resistance line. And again, the dollar yen is highly correlated with the stock market. The Dow dropped over 400 points today, so that could be a reason why the dollar yen sold off a little bit, not as much as would be expected considering the carnage in the stock market. The last chart is the Kiwi dollar, and we are getting closer and closer to that entry near the 54 figure. And again, this is a trade that I've been watching for the past several reports in the last, I'd say, about a week now, waiting for prices to come down near that 54 figure. They almost got there today, but again, this is something that I'd wait for over the next few hours, maybe over the next day or so, to see if we can get an entry near that 54 figure. What I'm personally looking for, I have an alert set now, is for prices to hit that figure exactly at the 54 level, where I'm going to enter and place my stop beneath that 53.51 low, maybe about 10 or 15 pips beneath that low. To reiterate, and again, I have low confidence in this trade idea, but just looking at the chart objectively, you can argue that the sell-off from just above that 61 figure is corrective, and this is the key point I want to make here is that the risk to reward is excellent on this trade, even though my confidence is low. I personally think maybe there's a 30 to 40% chance that 53.50 low will hold, but the upside is tremendous if it does, because as Jamie was mentioning, there is a possibility that this is the bottom of the B wave, and if that occurs, if this is a B wave bottom, we should expect a C wave rally to equate or exceed that 61.26 high. Again, my name is Matt Russell. I'm an FX Power Course instructor here at FXCM. Thanks for listening.